Hi, I'm PNC Joe, and I only talk about commercial insurance. Today, let's explore the nuances of building coverage, a vital safety net for safeguarding your business premises. Many small business owners underestimate the challenges of selecting the right coverage, potentially leaving their assets vulnerable to unexpected disasters. The complexity lies not just in choosing adequate coverage, but also in understanding how variables like location, building use, and potential risks impact your overall policy decisions. Keep watching because in this video we will discuss these important topics. What is building coverage? What is covered under building coverage? How is the value of the building determined? Replacement cost versus actual cash value. How does co-insurance affect my coverage? Common included coverages. Are there any exclusions I should be aware of? Coverage for natural disasters and a bonus topic at the end. Let's go through these points one at a time. Building coverage is a type of insurance that helps pay for damage to the physical structure of a building, like walls, roof, and floors. It acts as a financial safeguard for your property, potentially allowing you to fix or rebuild if something bad happens, like a fire or storm, subject to the terms and conditions of your policy. It's important to have because buildings are expensive to repair and replace. Building coverage typically covers damages from specific events like fire, lightning, windstorm, or vandalism. For example, if a tree falls on your building during a storm, building coverage may help pay for repairs, subject to the policy's terms, conditions, and limits. However, it usually doesn't cover things like earthquakes or floods unless you add those protections separately. The value of a building in insurance is often determined by its replacement cost, or actual cash value. Replacement cost is the amount it would take to rebuild or repair your home with similar materials. Actual cash value is the replacement cost minus depreciation, how much the building's value has gone down over time. Replacement cost and actual cash value are ways to figure out how much money you might receive from an insurance claim. Replacement cost provides enough to rebuild your building as it was before, while actual cash value gives you money based on the building's current worth. For example, if your roof costs $10,000 to replace but has depreciated by $2,000, the actual cash value would be $8,000. Co-insurance is a clause in an insurance policy that requires the property to be insured for a certain percentage of its value, usually 80% or more. If you don't meet this requirement, your claim payout may be reduced, meaning you might have to cover a larger portion of the repair costs yourself. For example, if your building is worth $100,000 and you insure it for only $70,000, you might receive a reduced payout on a claim. Some common coverages included with building insurance are property damage, business interruption, equipment breakdown, debris removal, and ordinance or law coverage. Property damage covers repair costs from events like fires. Business interruption covers lost income if your business has to close for repairs. Equipment breakdown covers repairs to essential equipment. Debris removal helps clear away wreckage, and ordinance or law coverage helps with costs if you need to meet new building codes when repairing. Exclusions are things that are not covered by your insurance policy. Common exclusions include flood, earthquake, wear and tear, and intentional damage. This means if your building is damaged by a flood, the insurance won't pay for repairs unless you have specific flood insurance. Building coverage usually doesn't include natural disasters like floods or earthquakes without extra coverage. If you live in an area prone to these events, you might need to buy additional policies. For example, a business in California might purchase earthquake insurance separately to ensure they are protected. Policy limits are the maximum amount an insurance company will pay for a covered loss. Sublimits are smaller limits for specific types of losses. For example, your policy might have a $100,000 limit for building damage, but a $10,000 sublimit for damage to outdoor signs. Building coverage is crucial because it protects your investment. Buildings are expensive to repair or replace, and without insurance, you might have to pay these costs out of pocket. For example, rebuilding after a fire can cost hundreds of thousands of dollars, which is a huge burden without insurance. Understanding building coverage is a vital step in ensuring the safety and security of your business property. By grasping these concepts, you can make informed decisions, protect your assets effectively, and secure a stronger future for your business. Remember, while insurance can seem complex, investing the time to understand your policy pays off in peace of mind and financial stability. If you have any questions or ideas for future videos, please let me know in the comments below.